Gold just crossed a price level that most financial analysts said was impossible 5 years ago, and now some of the biggest banks on Wall Street are saying this may not even be the peak. In this breakdown, we are going to look at why gold exploded, what forces are driving it higher, and whether investing now still makes sense. Let's start with the numbers. Gold closed 2024 around $2,600 per ounce. By the end of 2025, it surged past $4,400 per ounce, a gain of more than 60% in a single year, the strongest annual performance since 1979. During 2025 alone, gold set more than 50 all-time highs. With geopolitical tensions escalating in the Middle East, futures have now traded above $5,000 per ounce. So where does it go from here? To understand that, we need to understand what pushed it this high. There are 5 major forces driving gold simultaneously, and that kind of alignment is rare. The first and most powerful force is central bank buying. Central banks, which manage national reserves, have been purchasing gold at historic levels. In 2024, global central banks bought over 1,092 tons of gold. In 2025, they added another 863 tons, far above the long-term average of 473 tons per year between 2010 and 2021. JPMorgan forecasts central banks will continue buying around 800 tons in 2026. Why? The answer goes back to 2022, when the United States and Europe froze Russia's reserves after the Ukraine invasion. That event changed how governments think about holding assets. If dollar reserves can be frozen, countries need an asset that cannot be seized. Gold fits that role perfectly. A June 2025 survey showed 76% of central bank managers expect gold to form a larger share of global reserves within 5 years. 95% expect their own reserves to grow in the coming year. This is not speculation. It is a structural shift. The second major force is the weakening US dollar. Gold and the dollar usually move in opposite directions. As trade tensions rise, US debt expands, and confidence in the dollar faces pressure, international investors look for alternatives. JPMorgan modeled a scenario where foreign investors shift just 0.5% of their US held assets into gold. That small reallocation alone could push gold towards $6,000 per ounce over time. The third force is inflation and real interest rates. Gold performs well when real rates, interest rates adjusted for inflation, are low or negative. When savings accounts earn less than inflation, the opportunity cost of holding gold disappears. Mixed inflation signals in 2025 kept the Federal Reserve cautious, but long-term inflation concerns drove investors toward gold as purchasing power insurance. The fourth force is ETF demand returning. Between 2022 and 2024, investors were pulling money out of gold ETFs. That trend reversed in 2025, with around 250 tons of inflows into gold funds. JPMorgan expects this trend to continue into 2026. The fifth and most immediate force is geopolitical risk. When uncertainty spikes, capital moves towards safe haven assets. Ongoing tensions involving the US, Israel, and Iran have added a risk premium to gold prices. Now let's examine institutional forecasts. JPMorgan has issued a 2026 gold target of $6,300 per ounce. Raising the floor means even during pullbacks, gold is unlikely to revisit old levels. Goldman Sachs raised its outlook to $3,700, with extreme scenarios near $4,500. HSBC and others also forecast $5,000 in 2026. The World Gold Council outlined 3 scenarios for 2026. A stable baseline, a moderate slowdown with 5-15% gains, and a bullish risk escalation case with 15-30% upside. Even the bearish case suggests only a 5-20% correction before continuation. Silver has also surged, doubling in 2025 and reaching record highs above $66 per ounce. Unlike gold, silver benefits from both safe haven demand and industrial use in solar panels, EVs, and electronics. However, silver does not benefit from central bank buying, making it more volatile. Silver is higher risk and higher reward. Gold remains the more stable institutional asset. So is it too late to invest? History provides perspective. In 1971, gold was $35. Investors who bought at $100 felt late, yet gold went to $850. In 2009, gold was $900. Buyers at $1,000 felt late, yet gold reached $900. The real question is whether the forces driving gold are still in place. Central bank buying, dollar diversification, geopolitical tension, and inflation concerns are not fading. They are intensifying. Timing still matters. Buying at a short-term peak carries risk. Sophisticated investors manage this through dollar cost averaging, investing fixed amounts over time instead of trying to time perfect entry points. There are 4 main ways to gain exposure: Physical gold offers ownership with no counterparty risk, but storage and liquidity can be limitations. Gold ETFs like GLD, IAU, and SQL offer convenience and low fees, though investors hold shares rather than physical metal. Mining stocks such as Newmont, Barrick, and Agnico Eagle offer leveraged exposure. When gold rises, their profits can rise faster, but they also fall harder during corrections. Futures and options provide leverage but are unsuitable for most retail investors due to complexity and risk. Traditional allocation advice suggested 5 to 10% gold exposure. In today's environment, many institutions allocate 10-15%. Gold currently represents just 2.8% of global financial assets, small relative to equities and bonds. That leaves room for demand expansion. Gold is not only about returns, it functions as portfolio insurance. When stocks decline, gold often stabilizes or rises, providing diversification benefits. Risks remain. A strong U.S. economy, falling inflation, and aggressive rate hikes could trigger a 5 to 20% correction. Rapid resolution of geopolitical tensions could reduce the risk premium. However, given the structural nature of central bank accumulation and global diversification trends, most analysts view potential corrections as temporary pauses rather than the end of a bull market. The intelligent investor acknowledges both risk and opportunity without emotional extremes.